I will try to go into detail about how interest rates are arrived at, right? Piggyvest interest rates are based on market behavior. Now, there are two types of financial institutions, right? There are ones that are focused solely on returns, right? Because when you open an asset management account, they'll ask you, what's your focus, right? Capital preservation or returns, right? We are capital preservation. Why? Because the biggest thing for us is, first of all, to return your money back to you when it's time. The second thing is to pay you sustainable interest rates on those monies. Now, people who focus on returns do some very interesting things with money, like lending to individuals, right? So if you step back and think of those platforms whose interest rates you are comparing with Piggyvest, you find out that they have a lending arm, right? Lending to individuals means you get higher than normal returns because you are billing people to pay back the people whose capital you are lending out. We don't do that, right? Our investments are in little to no risk instruments, and that means that, see, the higher the risk, the higher the return. The lower the risk, the lower the return, right? So we are underlying our underlying assets for our investments are safe ones like treasury bills, commercial papers, bills, bonds, which means that when we invest as a pool, we're getting slightly lower returns on our own investments because we're focused on preserving it. We're not trying to take those risks with your money yet, or at least we want you to be able to opt in. So yeah, we've just increased our rates because we now know that these new numbers are sustainable. If rates continue to go up, we'll review again and take them up to a rate that we know that we can continue to pay, right? I don't know if you've been using Piggyvest long enough, you remember that during COVID, we dropped rates, right? We dropped rates. Why? Because rates dropped, right? So when rates increase massively, we'll increase our rates as well and pass on more to you. But when they drop, we drop them. But our focus, because dropping rates is a really negative impact on both us and you guys as users, that we increase our rates to rates that we can actually maintain in the short to medium term and cushion the effects on the market on your money.